Welcome, Ryan Banner, to my podcast and all listeners to my podcast called Capital Strategies. And I hope you like that name, Ryan. I came up with that name because one, we work with capital as in money. And then two, it's like a capital idea, right? Like a good idea, a good strategy. And then three, I'm from DC, the capital. Um, that's where I came up with that name. But thanks for being on here. Today we're
Thanks
talking
for
about
having me.
what's that?
So thank you for having me.
Oh yeah, yep, absolutely. Well, thank you for being here. I'm very excited to have you here to talk about structured notes, which is I know one of your favorite topics. And so to give people some idea of structured notes and your experience, you started using them in 2017 when they were a very not well known product. And I would say that they still are a very, unknown and, a lot of complications about them that people don't understand. So that's why I wanted to bring you on to kind of shed some light on what they are and how they work. And so you've been in the space longer than most advisors, and you're actually making your own customized notes, which is very interesting. So can you talk a little bit about what structured notes are and how they work?
Yeah, so I guess just to give some background, notes have been around for a while, but the penetration within the U.S. is pretty low. Historically, you've had to be, maybe a multi-million dollar client working directly with some of the investment banks to gain access, where now we're able to give access through the relationships that we've built with investment banks to clients, of maybe not any portfolio size, but a wider range of portfolio sizes where we deem that it is a suitable investment for them. And we can dive into that later in the call. But higher level, market link products are financial instruments that are a bundling of securities into one unique security by an investment bank. So, under the hood, that could be a component of bonds, options, indexes, or other derivatives in order to create a unique strategy where the investment bank pays out based on those terms. And so they can have various degrees of protection on the downside or participation on the upside. It can be designed for either growth or for income purposes. So there's a wide range of design within this space, and you can get very customized to a specific exposure or risk profile.
Got it. Yeah. So I guess the main question that investors will have is why should they utilize a structured note compared to something like stocks or bonds?
Yeah, so the highest level explanation that I like to give, most investors understand the idea of risk versus reward, right? We take on more risk, we get more reward. We take on less risk, we're probably going to, have lower reward. But in reality, like many other things, it's really the engineering triangle, right? There's three components, and that third component is liquidity. So if we take away liquidity by locking up funds for a stated term within the note, and there could be features that might have it end early. I say note, but that could also be CDs, so market link products. Trading off that liquidity, maybe we can have protection on the downside, be able to eliminate some of the risk or reduce some of the risk without giving up upside, or maybe we're enhancing returns. So it's introducing that third component of liquidity in order to gain, potentially higher participations, leverage returns or enhanced returns, as well as protection.
Gotcha. Gotcha. So you're talking about, a client who has a portfolio of stocks and bonds and, maybe they don't need all of it liquid at once. And, they're okay with locking a portion of it up.
Right. And so generally speaking, the we're not going to want to tie up the majority or even close to the majority of a client's liquid net worth. So I tend to use like a 30% rule. I don't want to lock up more than 30% of liquid net worth. So the majority of any of our clients' assets are going to be liquid, but most people have a portion that they can say, you know what, I don't need liquidity on this piece. And over time, we start building out even that illiquid portion is kind of rolling where, there are kind of laddered maturity dates that start building out over time. So like I personally try to buy, notes on a quarterly basis. So now I have a quarterly block of my portfolio that is maturing at any given point. And so, I don't have to sell out of other investments, maybe at a time period where the market is down and I don't want to sell anything.
Gotcha. Okay. And can you give an example of, do you have one by chance, just like that you've been looking at lately, so people can have some example of what it would look like in a real portfolio?
So I don't think I can give a very specific example because we don't want to give potential investment advice, but to give an idea of a type of structure, one of the structures that I use very commonly, especially for those that maybe it's in a retirement account, you're younger, you say I don't need liquidity on this, something I've bought in my own Roth account where I don't feel I need any liquidity in my Roth, would be buffered notes. So we talk about the different types of protection, and we can scale protection from things like buffers. Buffers absorb, so maybe the first X percentage of losses are ignored. Some notes can be fully principally protected, backed by the issuing bank, or we can go all the way to FDIC insurance, up to FDIC limits. And obviously, the more protection you put, that might reduce the reward. One of the you start reading about articles in this space and they're going to talk about caps. Most of what I write is uncapped. I don't like limiting returns, but maybe we don't have enhanced returns. What do I mean by enhanced returns? So again, type of note that I might use, let's say it's a fixed 5-year investment, might tie to an index like the S&P 500 or something that tracks the S&P very, very closely. Paying, like the last iteration I did, paid over 1.6 times the returns on the upside with no limit. Meaning if at the end of the 5-year period, the S&P is up, 10% on average, say per year, so up 50%, and it says that there's, 1.6x participation, then you're making 80% on that upside, assuming there's no limit. And then on the downside, maybe it has, a 20% buffer. So first 20% of any losses are ignored. Can also add in features like absolute return, where you actually make money inside of that buffer. So, if it's down 10 in that 20% with an absolute return, you make 10. The effect of that, so if you're making more when it's up, you're losing less or making money when it's down, you're always outperforming the underlying index, unless there's a zero. And so sometimes, depending on the duration, we'll run the back testing and see that it says inline performance, like the last one I ran said 0.05 inline performance. So somewhere in there, there's a zero, and 0 versus 0 is inline. But in that case, you're still trading off. You're saying, okay, I'm locking up these funds for 5 years, and I know that 99.95% of the time, it's going to outperform the underlying index because of those enhancements.
Yeah, absolutely. Yeah, that's great. I mean, past performance is no guarantee of future results, but back testing these, they have outperformed the S&P or for this specific index 100% of the time. That's no guarantee that it will in the future. But so, what are some of the
Well,
benefits? Oh, go ahead.
I'll just clarify. So we can tie these instruments to, most major indexes, and I try to stick to, a lot of the larger indices, things like the S&P, the Russell, the Dow, the Nasdaq. We can get customized and start using other indices or ETFs as long as they're highly liquid and something that I as the advisor, but as well the firm has approved. We don't want to start tying things to some random index that no one's ever heard of. But some of our clients might want specific exposure. Maybe you want exposure to gold or hedges against it for whatever reason, or international exposure. So there's lots of different indices we can choose from. And then as far as that performance, you're going to know upfront exactly what those calculations against the underliers are. So when we talk about it potentially outperforming based on back-tested data, it depends on the duration the index has been in place, how long that data can go back. If you're tying something to the S&P, you can look at data going all the way to the 80s. And so history can certainly be a guide to that performance. If you're looking at an index that's newer, maybe a lot of the banks create their own indices. in order to provide what they feel are more attractive terms. Maybe the data doesn't go back as far. So that's something that we always want to make sure that we're doing a lot of analysis when I design the notes to make sure that I feel that it's or feel confident in the way that it's designed and it's going to achieve the goal for the clients.
Gotcha. Yeah. So can you go into kind of how you customize notes and how that works and should a advisor be, talking to someone who customizes their own notes? Should they be going to, what are the options that some people have?
So there's a lot of different options. So some of that discussion on what we're tying the notes to in terms of the indices, how the payouts are structured. Do you want income? We can design a note that's paying out a monthly coupon. We can design something that's paying out quarterly. Maybe this isn't a non-qualified account. We don't want to receive income. Instead, we say, after the first year, it's potentially callable. If the index is above a certain level. Maybe we design it where we say, okay, if the underlying index is not down more than 10% after the first year, it gets called. Those call features could be, every year, that could be monthly, so it just depends. But the advantage of using a structure like that is now it comes out as long-term cap gains if principal's at risk. Anytime you're using something like a CD, so if there is no risk to principal, then any gains are taxable generally as income. And I say this not as tax advice. Of course, any client needs to refer to their CPA for any tax implications, but we do want to try to keep tax efficiency in mind in that design. So there's ways to create highly predictable returns through callable structures versus a income where it's paying out every month. At the same time, flip side to that is getting that monthly paycheck for many is attractive, especially when we're doing retirement income planning, and we can achieve higher distribution rates on the portfolio overall by enhancing that yield through notes. As far as some of those other customizations, again, that could be things like how deep the protection is, adding features like the absolute returns, tying to different indexes or exposure, trying to not time the market, but time periods where certain indexes might be pricing better. Maybe there's some more volatility in the market, and that's helping the underlying components that allow us to give more enhanced returns or deeper protection. Or higher yields. The current interest rate environment has been very attractive and helpful in designing some of these structures. I don't know if that kind of answers the question.
That definitely does. Yeah, and it's very interesting to talk to you and hear about some of these customization aspects. Like for example, yesterday we were talking about a note that actually is the election note, right?
Yes.
And by the time this airs, the election will probably be over. But I just thought that was interesting. If you could talk briefly about that and just the power of the customization with these notes.
Yeah, so that was a note that was designed to allow investors who want to enter the market, but there's a lot of fear right now with the election. We don't know what the market's going to do. Historically, the market tends to rise after an election, but depending on which way it goes, maybe we see a short-term pullback. And so the design of the note says that the starting point for the underlying index for calculations, and in this case, it's a 2.5-year investment, but the starting point is the lowest value of the index between November 5th and December 5th. So now we eliminate some of that market timing because we're automatically going to get the low point as our starting investment spot. And so there's structures like that. I mean, you can build a look back period up to 6 months. Sometimes, obviously, the longer the look back period, that might limit your upside. So part of the reason for doing 1 month is that still allowed us to have 1.1x payout on the upside with no limits. And still maintain 15% buffers. So it's a very attractive way to allocate to an index that tracked the S&P very, very closely. So there's lots of different ways to design these structures, and you can get very complex with them. One of the advantages that the clients have in working with us is being able to bring instruments like this that are differentiators. You mentioned my love of notes. It's partially because very rarely do I talk to somebody who has exposure to this asset class, and it's one that I feel adds or has added a lot of value to my clients. One of the things I didn't share before, part of how I found them originally, until the last couple of years, the bond market didn't make sense to me. I couldn't understand why anyone wanted to buy bonds when you were almost guaranteed to lose money. But I couldn't put all my clients into equities alone. So I needed something alternative that might have a risk profile more similar to a bond, but be able to give equity-like returns. So something like an FDIC insured, market-linked CD, maybe that has a limited upside, but we're not risking principal, so we've got that safety net there, and can still achieve returns greater than what the bond market was paying. So when I looked at my portfolios in the bottom of the market in COVID, and I didn't have a single position, whether note or CD or PPN, that was below its protection levels or matured in the bottom of the market in COVID where a client lost money. And I think that's really impactful when you're doing reviews and looking at bond funds that were down 30%. That safe side of the portfolio didn't feel so safe in the COVID drawdown.
Yeah, absolutely. So it sounds like there's a lot of good things about notes, like the protection and the customization. Um, and then obviously the downside is that liquidity. So how does someone uh get their, let's say that they have a liquidity event where they need that money, some emergency comes up. How does that work?
So all notes will have a stated maturity. And the only guarantee that we can offer is that it will mature on that date. There is no guarantee that a bank will allow you to cash out early. Now, we can go back and ask the bank, basically, put in a bid and say, will you buy this back? And they're going to come back to us, in the same day and say, here's what we'll offer to buy to close out the note. And if an index is positive, if the underlier is positive, most of the time you can capture most of the returns. Maybe we're capturing somewhere between 90, 98% of the upside that we've achieved. And maybe it makes sense for us to do that. I have had a sizable block. We were well above the protection levels. I could reissue with a higher participation rate going forward. So it made sense for us to take a little bit of a haircut on the upside we would have captured if it matured on that day to get those enhancements, reset the protections. If the underliers are down, the stated protection levels, even in something like a market-linked CD, those protections kick in at maturity. Market-linked CD, there's often a bond under the hood that's maturing at that stated maturity date that's protecting the principal. So if you tried to cash out early, you could experience a loss, assuming the bank even lets you buy it back. I think another really important thing to note, though, in terms of risks, is that there is credit risk associated with these products. We are issuing through some of the world's largest investment banks that we feel comfortable with. We're not trying to go to some investment bank no one's ever heard of to issue these types of products, but there is credit risk associated with them. They unless you're adding FDIC insurance, whether it's a principally protected note or a market-linked note, those are unsecured debt being issued by the bank. So it is important to note that there is credit risk associated as well.
Interesting. Yeah, yeah. I appreciate you talking about that. So there are some pros and there's some cons. So how do you incorporate them into an investment portfolio? One thing is like, how would you classify these? And then two is like, how do you determine if this is suitable for someone?
Well, suitability is really dependent on the goals. We want to make sure that there is plenty of liquid assets. Again, we don't want to go over just as that rough rule of thumb, that 30% figure. But just because not everybody 30% was appropriate, we might determine based on their goals and their needs. We don't want to lock up more than 10%. Maybe we determine it's not suitable. They really need liquidity for whatever reason. So suitability is really individualized, and of course we need to talk through an investor's goals and what their assets look like, so that we can make good recommendations and they can make an informed decision. As far as how I incorporate them, again, that depends on the stated goal, right? So from an asset class standpoint, they're somewhat their own asset class. I might treat them as part of my bond exposure or part of my equity exposure. Within our systems, it's going to always classify them as bonds, but because they are technically a fixed income instrument. But to me, within a aggressive portfolio, I'll pick on myself, right? In my own Roth, I'm 33, right? I'm not trying to, or I'm not that concerned about long-term volatility, but trading off to buy a note that's got enhancements on the upside, that has some of the downside protection, not giving up anything but liquidity by buying it, and it's tied to an equity index. To me, that risk exposure might be, or that upside exposure is giving me equity-like returns. So it's just a little bit hard to classify them as far as the traditional asset class. System's still going to show it as bonds. Now, I'll give another example, right? If my clients who are in retirement, we're trying to generate income, I might be using a note as part of the fixed income portfolio as an alternative to traditional bond funds for things like that downside protection, not being correlated to the bond market, being able to have potentially higher yields than traditional bonds.
Gotcha. Yeah. I mean, this structured notes seem just like such a important part. It can be such an important part of someone's portfolio, which begs the question, why do you think this hasn't kind of caught fire in, the United States? I know it's a little more popular in Europe, but even there, why do you think that is?
And I don't know, I don't have good data as far as that penetration. I know some of the firms that we work with have told me, it's like 13% penetration in Europe versus 3 in the US. So a pretty significant difference there. As part of the why, the complexity behind it, right? So we have hundreds of offerings every month through all the different banks, can design a lot of customized terms. So from a sales standpoint, it's a more complex instrument that we need to take the time to make sure that our clients understand. And the terms are going to vary month to month. I go through hundreds of offerings to help determine, what do I feel is the best growth opportunity? What do I feel is the best income opportunity? What do I feel is the best, if I need something on the shorter tenor? I don't want to lock up for 5 years. Or, what is best? Is 5 or 6 years giving me the best return if I don't care about duration? So it's a bit more work on the back end to manage. And from an issuance standpoint, once we have the terms for a particular structure, it trades at one time. So, maybe that's 11 a.m. on Tuesday and it's gone after that. And when we build custom terms, sometimes we might only have a couple days to write it. And so it just can make it a little bit more challenging, which is why I think a lot of advisors just don't want to dive into that space or just don't have the expertise. And then plenty of firms don't have the relationships that we do with investment banks. So plenty of advisors might not have the access. And there might be very high minimums depending on the platforms to give access to products like this. So it just really depends. I think those are some of the key reasons, though, that there's less exposure.
Yeah, absolutely. And do you see this thing catching on a lot more in the future, like 10 years down the road? Do you see us this becoming a lot more popular, maybe becoming a household type of solution that people have in their portfolios?
I think from a popularity standpoint, they've been steadily growing, over the last decade. Definitely caught on a lot in the last several years. People are looking for ways to protect their assets. And there's other asset classes, we see plenty pitching things like annuity products in order to, provide protection on the downside. But, from a tax efficiency standpoint, there's tax implications that may not be suitable for every investor. I see a lot of cases where I can give better returns or better upside, not limiting upside. And it's funny, you've mentioned structured notes a couple of times, and notes are one of the market-linked products. But if someone plugs in, market-linked CDs, market-linked notes, and they're reading articles, one of the first things that often comes up is caps. And all else being equal, a product tied to the S&P and a note from an investment bank versus a buffered annuity product from an insurance company, the costs on the insurance side are higher. So those caps, if they're may be much lower. So I've seen cases where in the same day of issuance, right, on the annuity side, something on the S&P maybe is capped at 80% returns, meaning you can't make more than that over the time period. Where on the note side, I have no cap and enhanced returns. There's some multiplier. And we're giving up the same amount of liquidity. Maybe we have the same buffered protection on the downside. It's just the differentiator in terms of structure. Now, again, we'll go back to that risk standpoint. Credit risk is different on the investment bank side versus on the credit side. But when we're going to some of the world's largest investment banks in the world, some who've never taken bailout money, there are, I think that analysis on the credit risk and explanation is something that we leave to each investor. We're obviously not going to issue again through a firm that we don't feel confident in.
Gotcha. Okay. So a lot of, this is a very sophisticated product. So how does an everyday Joe go out and buy one of these things?
Through us. The reality is you're not going to one of the discount online brokers and buying notes. I'm not aware of any that offer them. One, because they are more complex instruments. They do trade at specific times. They're not an over-the-counter type trade, and so it is something that you really should be working with an advisor who has experience in the space, who knows how to design them. I mean, I look through the thousands of issuances, and one of the things that I do every month as well is look through the issuances from firms other than our own, where maybe there's an index that we don't have approved. We're not allowed to sell it yet. From our broker dealer does limit some of the indexes, and I can totally see why, because I look at some of the wild terms that advisors put out, and I look at them and say, wow, the risk of this breaching its protection levels and a client losing funds is way higher than I'm comfortable with. History should only be a guide, right? But when I run back testers, I typically am targeting 5% or less historical chance of loss, right? I don't want to see something that is breaching its protection levels half of the time. That defeats the whole purpose for me of why I want to enter this asset class. Maybe not in every case, in most cases, since again, it's going to depend on the client's specific goals. But I think that's, as far as, the why or how you buy it, it's through somebody who who's going to clearly explain how they work, what those terms are, be able to help digest the, sometimes 80-page term sheets that come with these, or complicated calculations on how the returns are done, to be able to clearly explain how it's designed and why. Not where, it's the one-off, or it's a, some, I don't know, an index that no one's ever heard of.
Yeah. So you said that you've seen other advisors selling these notes that are uh, that like why do you think they're selling these that are not doing have this high chance of loss? Do you think they're just incompetent, or do you think is there something more nefarious behind it?
No, I think one of the easiest explanations, we'll look at yield. When you're trying to generate, yield, especially in periods where, some of the major domestic indexes like the S&P, the Russell, the NASDAQ, maybe their volatility is lower and we're not getting strong yields, and adding some other index that's, more currently more volatile is giving higher yields, but those indexes then come at additional risk. And there are some proprietary indexes from the major investment banks, or as well issued by firms like the S&P. The S&P makes more than the S&P 500. So there are indexes that can have differentiated return and risk profiles, but I think it's important to make sure that clients understand those risk profiles, understand what they're buying. So I think that's one of the key pieces. And it's just when I look at some of the issuances of Actually, I'll give an example too. Looking at some of the issuances that we don't have, where it's worst of a couple of specific companies. Maybe it's 3 different specific stock tickers, and maybe that yield note is paying out 11.5% when I can get 10% on the S&P 500. You don't need to be an expert to understand that if the underlier in a note is 3 specific companies versus the S&P 500, the S&P is going to be less risky, right? We've got diversification there. So that's where, to me, a lot of times that little bit of additional yield that you're squeezing out to go into specific stocks maybe isn't worth it over a diversified index.
Yeah, absolutely. So you want to have a advisor, it sounds like, to help walk you through this and to help you make smart decisions on this. Like, for example, you were saying, there's some notes that just, I mean, they're risky. Let's just say that they're risky, and we want to make sure that our clients are taking more risk than they have to achieve their desired goals and the returns that they're looking for. So, uh, making sure you have an advisor who understands these things is crucial, um, because a lot of advisors, they don't offer this.
Yeah, and because we talked about the different ways we can customize, different structures price better in different market environments. There's different levers we can pull in terms of the design to help, maximize the outcomes for our clients. And sometimes I'll give one last quick example. Sometimes that means giving up some of the return. Maybe we increase the probability of a note ending early by giving up a little bit of the potential yield. A batch of structures recently where we could choose an 18% or a 15% call structure, and the 15% just had a much higher probability of ending early, and giving our clients positive returns and back tests much better. So that little bit of difference in terms of that upside, most of my clients are not going to complain about 15 versus 18%. And if that's something they'd complain about, we'd have that discussion up front so they would know exactly what they're getting into when they're purchasing a product like this.
Gotcha, gotcha. Okay. Very interesting. Okay, great. And last question is, does is this impacted by interest rates? How does that work?
So yes and no. Yes, interest rates impact the design of the notes, what's pricing well, what type of how they price up front. You're not getting impacted in the sense that once issued, the yields on a note, if we're designing a note for income, we're not going to see a reduction in payout because interest rates decline. So we're able to lock, any terms that we're locking those terms before issuance.
Okay, great, great. All right, well, thanks, Ryan. Thanks for being on the podcast. It was an interesting conversation, and we've talked a lot about structured notes, and I think this is a very important thing that a lot of people should understand. Is trading some liquidity for some enhanced upside and downside protection, I think can be, a very useful part of someone's portfolio. So, thank you for helping us navigate this complex, new industry. And any other final thoughts before we go?
No, it's just, I reiterate that, I love sharing this space because it is something different. It's something we're trying to give access to a wider range of clients to help them achieve their financial goals. And that those benefits that we're providing as far as, potential protection and enhanced upside, you're not finding that in a lot of asset classes. But they're not going to be right for everyone. So of course we want to talk through, what is someone's liquidity needs, what is their risk profile, what do their assets look like, so that we can help someone make an informed decision, and at the end of the day, put things that are in their best interests in place. So I think that's, it's just an important differentiator and something worth taking a look at.
Okay, awesome. All right, thank you.
Thank you. Have a great day.